Good morning, everyone. This is Don Owen, and this is DFY Informed. Thank you for watching. Was going to try to do a real short video, like a minute short, but I couldn't do it this morning. There's just too much to talk about. I wanted to share some numbers with you, and I'm going to get started with the numbers right off the bat here. These numbers are layoffs announced just since Christmas. Capital One, 1,100. Google, 12,000. Wayfair, 1,750. Intel, 201 and more to come. Washington Post, layoffs coming, undisclosed number. Microsoft, 10,000. Amazon, 18,000. Ryder Corporation, 800. Vodafone, hundreds. Apple retail stores, undisclosed numbers. Mellon Bank, 1,500. DirecTV, 400. Google Health Sciences, 250. Wendy's and McDonald's have both announced that they're going to be doing layoffs. Salesforce.com, 7,300. And Goldman Sachs, 3,500. Again, folks, those are just layoffs announced since December 25th. So what am I wanting to talk about this morning? There's a couple of things I want to share with you. It's going to be full of numbers, and I'm going to throw some charts up on the screen, so I want you to have all this information. But if you listen to the mainstream media, you get the sense that the economy is doing great, that we're in recovery, inflation's coming down, although inflation's still 6.5% over last year, the rolling 12 months. So it's still 3 times higher than what the Federal Reserve wants to target as long-term inflation, which is still 2%, even if that's too high. But nonetheless, so yeah, you'll hear the term disinflation used. Don't confuse that with deflation. Disinflation just means the rate of inflation is coming down, meaning prices aren't going up quite as quickly as they were before, but they are still going up. So keep that in mind. But if you want to think about the overall economy right now in terms and put that in context, so I just gave you a list of a bunch of layoffs, and the website I'm going to is right down here. It's dailyjobcuts.com that I follow every day, looking at these layoff announcements, and you can go back and look at your own history if you want to. But every day, big companies are announcing more and more cutbacks. But let's talk about a couple of other things. So pulled a report here that looks at buyer demand in terms of housing. From November 2021 to November 2022, there is about 25 markets, major markets, that experienced a greater than 40% decline in home sales. These are like, I'm just going to a few of them: Vegas, San Jose, Phoenix, Crestview, Florida, Daytona, Florida, Seattle, Washington, Washington, D.C., Los Angeles, Boise City, Idaho, North Point, Florida, Denver, Colorado, West Palm Beach, Florida, Birmingham, Alabama. A number of cities that are experiencing huge declines in home sales. Let's talk about backlog of apartments. So as of the end of at the end of the year 2022, there were 909,000 new apartment units under construction. 909,000. Now that number has not been seen since the housing crash from 1974, when right before the crash there were 916,000 apartment units under construction. And then the bottom fell out. And I will put that chart up and you can see that on the chart. What's scarier even still is the number of completed units now, as compared to back then, is not even 400,000 of those 900,000. So what you may end up seeing is kind of like China, a lot of empty apartment buildings that are just sitting there under construction but never get finished, especially with the Federal Reserve raising interest rates. The inflation adjusted home prices have never been higher. What also hasn't been this high in a long time is the payment to income ratio for 30-year mortgages. So consumers or home buyers right now are facing an average monthly payment that's equal to 37.4% of their gross income. Now, that number has not been that high a ratio since 1982, which, if you recall, in 82, we had a pretty big housing correction. Interest rates, the average interest rate in December was 6.6% for a 30-year fixed rate mortgage. Does it stay just with the housing sector? No. The auto industry is getting hammered right now. Not so much on the new car sales yet, but certainly in the used car market. In December, there were 74,515 vehicles up for auction. Now, based on the research that I've done and some of the videos that I've seen by people who participate in these auctions, an average number of cars coming through on a weekly basis is had been historically about 40,000. And again, so you're almost double that, 74,515. Of that, 15,648 for this little snapshot in time that I took are bank repossessions. So banks are trying to get rid of cars on the auction market as well and are unable to do so because buyers just will not meet the reserve prices. So the not no sale numbers right now are averaging about 45%, meaning of the cars that come up to auction, about 45% of the dealers are just walking away from the offers because they're not even getting their reserve prices. So that's that 15,648 number, according to again, according to my research, is normally in the 5,000 to 6,000 car range. More good news? No, not really. The savings rate for the personal savings rate in the U.S. right now is sitting at around 2.4%, and that number has not been this low since, well, my chart only goes back to 2016, but not anywhere close to it. It hadn't been anywhere close to this low in the last 6-7 years. But what's even scarier is if you look at credit card debt. So credit card debt right now for consumers is sitting at almost $1 trillion. Again, a rate or a level that has never before been this high, not even close. So you've got average credit card debt at the highest level in history, personal savings at one of the lowest levels that we've seen in decades. And the average interest rate on a credit card right now is roughly 19%, versus a average in the last, say, 4 years of roughly 15%, and before that down actually even the 13-14% range. So not good news overall for the economy in terms of outlook. So like I said, you've got the Main Street media, even financial media, which I used to listen to what they had to say occasionally. Well, actually more than occasionally, a good bit. I thought they had some credibility. To me, they've lost it. All they really know now is you got to be buying the dip and all. Well, I personally think, although I'm no financial advisor and don't claim to give financial advice, but I think a much bigger dip is coming. I think we're looking at probably something on the order of 2008, maybe on multiple fronts. Back then, it was kind of restricted to the housing market specifically and things that have supported the housing market. But right now, like I said, you've got it in used cars, you've got it in housing. Um, Commodities are high. How again, housing and asset prices in the stock market. The other um, comment I'll make is that if you look at the stock market right now, and the say the price to earnings ratio of the S&P 500, it's sitting in the low 20s right now. The PD ratio is for versus a historical average of about 15 and a half, 16. So to me, the stocks are still very expensive. If you look at Shiller's cyclically adjusted PD ratio, it looks even worse. So I think the market's pretty pricey at the moment. I think there's a lot of room for it to come down still. The Federal Reserve, uh, people are betting on, counting on a quote unquote Fed pivot. And, just because the Fed says, hey, we're going to slow down raising interest rates doesn't mean that they're going to begin either pumping money back into the economy through quantitative easing or lowering interest rates. They've already committed, they say, to keeping interest rates higher for longer. So we'll see. Um, so what does all this mean for your portfolio? Again, I told you guys at the end, for actually fourth quarter last year, be defensive. That's exactly where I'm at, in very, very defensive positions at the moment. In fact, I'm the way I'm structured at the moment, the market could crash and I'm still not going to lose money. So, and I'm not 100% in cash, by the way. So, yeah, that's just kind of what I wanted to talk about this morning. Again, sorry for the length of this video, but there's just so much information to share. I want you guys to be aware of what's going on. And as always, decide for yourself, informed. Thank you for watching.